Welcome to Small Biz Life, episode 101, Retirement Plans.
Does this sound familiar?
Oh my God, I have so much to do today.
Don't forget to breathe.
But I have almost 400 emails in my inbox and 30 phone calls to make.
Have you looked into getting a virtual assistant yet?
Oh, and I need to schedule all my social media posts.
Did you drink anything today?
I had coffee.
Did you eat today?
Did I mention coffee's a bean?
This is Small Biz Life.
Hey guys, welcome to another exciting episode of Small Biz Life. It's so weird saying 101, it's like 3 digits.
Back to the one again.
I know. It's so weird. So we thought, we get a lot of questions about this, about retirement plans, and what retirement plans are good for small business. And I think there's a lot of confusion about what people can and cannot do with retirement plans. You have a lot of advisors out there that are kind of pushing different types of plans, but then they're not factoring in like growth in your business and if your business changes. So we kind of thought we would take this opportunity to talk about all of your options out there, which ones are good. Like if you're never going to have employees, some different things to think about, and just kind of cover that in general.
Yeah, we don't know the stuff that can tell you, what's the best place to get returns. So we have individual opinions on that, but that's not our area of expertise. And no part of this is really my area of expertise. But from the business side, from the accounting side of things, from the numbers side, what's the best way can this benefit your business?
Right. So we're looking at this from a tax perspective, from a savings perspective. We're not going to, all of these plans, you can pretty much invest them in whatever you want. Okay. So we're not going to talk about the investments. We're going to talk about how do you save for retirement. Yeah. Because the problem is, most small business owners I'm talking to are not saving money for retirement. And it's a bad plan.
And in a way, I get the logic, right? It's like, I love what I do. Why would I want to stop? There could be a reason you have to stop.
Or the other mentality is people are like, well, I'll sell my business and that's going to be my retirement. And I think a lot of people who fall into that trap realize that their business is not worth as much as they thought because they are a major part of that business.
Yeah. The way you sell your business, most business owners, especially the ones that build it from scratch, typically overvalue what their business is worth. And it might be worth that to them, but when they sell it, they're no longer there. It's not worth that amount to the next person.
Right. And that's the thing is like, and a lot of my older clients are starting to sell their businesses, and they're realizing their businesses are not worth as much as they had hoped they would be. So this has got to be a key component.
Yeah.
Okay. So when you're thinking about what am I doing with my profits, you got to think about saving for the future. Okay. So, and that we've talked a lot about getting yourself out of debt, getting yourself in a better financial position. It's much easier to save for retirement when your debt is gone. And I'm talking about like everything but your house. Because then you freed up all that extra cash that you can actually put money away for retirement.
Yeah.
Okay. So we're going to start, kind of with the plans that allow you to put in lesser amounts of money that are kind of easier to set up that you may already be familiar with.
Yes.
And then we'll go into some of the bigger plans. Okay. So the first option that you have is just a traditional IRA.
Yeah.
And most people have heard of those before, right? That's something that, some people can put money into them, even if they have another plan at work, so some of you might be familiar with it that way. Maybe you used to work somewhere that they didn't have a retirement plan, so you kind of heard of IRAs that way.
Yeah.
So an IRA is something that you can pretty much open at any single, any online broker. You can open them at your bank. You can open them pretty much anywhere. There are 2 different types of IRAs. There's a traditional IRA and there's a Roth IRA. Now, I want to explain the Roth option for a second. any retirement plan that is not a Roth retirement plan means that the money that you put in goes in before taxes. So you basically get a tax deduction for putting that money in. When that money comes out at retirement, you pay taxes on that money as if it were wages. Okay, so there's no Social Security, Medicare tax on it, but there's full income tax. Okay, anything that says Roth means that you put the money in after you pay taxes on it, but then it gets to grow, and you never pay taxes on it again.
On the back side. And if especially the earlier you start your retirement investing, you're gonna have, if you do good with that investing, or start really young and do okay, you're gonna probably have more money at the back end, especially when you first start taking money out. So you have to kind of look at it, and this is something you have to look at your individual circumstances, talk to the people who you work with to get your estate put together, but find out, do you think you'll pay more in taxes if you pay it now or then?
I mean, I think most accountants would agree that income tax rates have to go up.
Yeah.
Because we just owe way too much money.
And which is also why you'll find that the Roth is usually the better option when you can do it, and that's also why they limit the amount you can put into them.
Right. So and you'll see that there are, you can have, like, some of you, if you may have a job, you may have a Roth 401k option at work. That works the same way as a Roth IRA. But for any IRA, either traditional or Roth, you can put in up to $5,500 per year. So it's not a tremendous amount of money.
No.
And if you're over 50, you can put in an additional $1,000.
Now, is that one? Are there income restrictions for that one?
There are actually some income restrictions. So, if you're single, and you have a workplace plan, whether or not you're putting money into it. Okay. So, like, if you still have like a job and you have access to a 401k, your income limit is $72,000 for 2017. If you're married filing joint, where a spouse is making a contribution to the plan, then your income limit is $119,000. And it starts to phase out before that. Okay. But you can't put any money in if you make more than $119,000. Now, here's kind of the interesting thing with IRAs. If you have one spouse that works and another spouse that doesn't work, the spouse that doesn't work can put money into an IRA. Okay. And the income limit is actually much higher for that person. It's actually $196,000 if you're married filing joint. So let's say you have one spouse who has a 401k at work. Okay. Or maybe one through, they have a retirement plan through your business. And then the other spouse is a, stay at home mom or dad and, isn't working for the business. That person can put money into an IRA. Okay. Because the other spouse has income.
Now, is it actually cheaper for you to make them not part of the business and give them an IRA? I mean, for tax purposes?
Well, if they're not working in the business, then you can't pay them out of the business. If they're working for the business, then you might want to consider making them an employee.
But the thing is, overall, from a financial thing, like from a tax purpose, strictly talking taxes, is it better to keep them out of the business or to have them part of the business and then let them do the IRA as well?
So if it's just the IRA, especially if you're making more than $120,000 a year, then it's probably better to leave them out of the business.
Okay.
Now, if you have like one of the other retirement plans we're going to talk about,
that could change.
Okay. But if you're just talking about like IRA, then and you're making more than $120,000 a year, it doesn't make sense. And the reason why the 120 is important is because that's when an individual stops paying into Social Security.
Oh, okay.
Right. So you're going to pay 12.4% tax into Social Security up until $120,000 in income. And there are some exceptions to that, but that's a general rule. So if you're making more than that and then you decide to put your spouse on the payroll, then you're going to start paying Social Security for your spouse as well.
Okay.
Right? So now you're increasing that $120,000 baseline. Okay. Because it's 120 per person, not per business. Okay.
Gotcha.
So that's why I think that's kind of important. And that's, that's why it's like, I know a lot of people, they're kind of resistant to like talking to accountants because they don't want to pay one. But it's like, this is the kind of stuff that we can help you with that you may not be thinking about. So it might be worth it to kind of sit down with an accountant for an hour, and just to kind of get clarification, especially if you're making a big decision like this. Like, what am I going to, should I put my spouse on the payroll? Should I get a retirement plan? Like, we can help you with that kind of stuff.
And that can, probably save you thousands, if not even more, especially when you talk about retirement planning, in the long term for, $100 to $300 an hour or somewhere. I'm assuming that you're going to pay a CPA.
Yeah, exactly. So, it's worth it for something like this. For a Roth IRA, they don't care if you have another plan. Okay. So for a Roth IRA, and the thresholds are much higher for the phase out. If you're single, the phase out is $133,000, which means if you make more than that, you can't put money into a Roth if you're single. And if you're married filing joint, it's $196,000. And that makes Jeffrey so angry because he's like, why don't you want people to save for retirement? Like, who cares how much money you make? You should put money in. Right. But it's really important to know those thresholds because as your business starts making more money, you might get phased out of these two retirement options.
Yeah, you might no longer have the option to, if you're using the Roth, you will lose it.
Exactly. So the other thing too, and this is available for any of the retirement plans, but there's this really cool credit that's called the Retirement Savings Contribution Credit. Okay. Most people refer to it as the Savers Credit. If you are single and you make less than $31,000 and you put money into a retirement plan, you will get a tax credit equal to up to 50% of what you put in just for putting money into retirement. So even if you put it into a Roth after taxes, you can get that credit.
That's only if you're single?
If you're single, it's $31,000.
Okay,
if you're married, it's $62,000. Okay. So, if you're kind of low income and you can, you figure 62,000 married filing joint is actually above the median household income.
I'll tell you, if I'm at home just starting off my first career, I'm saving just to essentially make a little bit more money.
Well, and here's the thing too, when we're calculating income for that number, if you put money into your retirement plan, like into a simple plan, a 401k plan, even a traditional IRA, that's going to lower your income, right? Because that money is taken out before taxes. So let's say that you made $65,000 last year and you're married filing joint. If you put $4,000 into an IRA, then that means that your income dropped below that threshold and now you're going to get a credit. Okay. So do you want me to say that again? So let's say you're like a little bit above the threshold, putting money into an IRA will bring you below the $62,000.
And the credits are the ones that you get the money irregardless?
It's dollar for dollar.
Okay.
So if you put, and I've got to look up what the limits of the credits are because I know that I think the maximum credit might be like $2,000. But, so let's say you put $2,000 into a retirement plan, you'll get $1,000 back in your refund. So basically the government is paying for half of the money you put in.
Wow.
That's really cool.
I mean, I think that's, you can just consider that a return on investment.
And that's kind of the way that I think of it is like, especially if you're a small business owner and you don't really have that employer match because you are the employer, this is a great way to get that match. Okay. So I love that credit and hopefully that stays around for a while. And unfortunately, a lot of people, especially a lot of low income people, don't know this exists. So I think, we as a society, accountants, financial advisors, we need to do a better job letting people know this exists. Okay, so those aren't really considered business retirement plans, but I know a lot of business owners who use them.
Now I have a question. Since they're not business retirement plans, can I use them in conjunction with the business retirement plans that we're about to talk about? Okay.
Yep. So, so we said when we talked about the phase outs, right? So for the Roth, I have a lot of my small businesses, especially my people who are older and more established, they'll have a business retirement plan, plus they'll put money into like a Roth.
And I have one more question before we go into the business ones, right? So I know savings important for retirement. And I can see why using a Roth can get you huge benefits. But if it's a traditional IRA, what's the advantage there over just opening an investment account? Because then I'm limited on getting that money back. If something does come up, I get punished if I take that money out early. Do I really get a benefit what would be the benefit versus just opening a retirement account and assuming I'm not going to touch that until I'm 65?
So a traditional is going to lower your adjusted gross income, right? Because it's deductible today. And there are some times where you're kind of, you're right on the limit for, maybe, if you don't take a traditional IRA, you won't get the child tax credit, which is a big one. Or maybe you won't get the American Opportunity Tax Credit for your kid's college, because there are limits for that.
Oh, okay.
And so sometimes we'll look at it and say, listen, if we can drop your income, by $5,000, now you're going to start to qualify for all these things.
So you're still getting the tax benefit. It's just on the other side of it. And you'd use that to try and maximize the money.
Right. So, in tax, the last line on your tax return on the first page is called your adjusted gross income. That number is incredibly important for a lot of different calculations. So when we even talk about the limit for a spouse who has access to a plan at work, they can't put money in if they make more than $119,000. You can't put money into a traditional IRA. That is based off of AGI. So if we can lower your AGI, then that means it's more likely you'll be able to put money into that plan. It's more likely you're going to get credits because all the credits phase out at a certain AGI. So that number on the bottom of your tax return is probably the most important number in the entire tax return, because that determines a lot of different things. That determines whether or not you get exemptions for your kids, whether your itemized deductions phase out, whether you can make retirement
in your house,
contributions.
whether or not you can write that off.
Right, whether you can write off losses for your, rental real estate. There's a lot of different things that depend on that number. And so sometimes, we'll look at, and the thing with an IRA is that you can put money into either a traditional or a Roth IRA until the due date of your tax return.
So until April 15th.
So with a lot of my clients, what we do is we do their taxes, and then we determine okay, you want to put money into the IRA.
This is the amount.
Do we do traditional or do we do Roth?
Oh, that's awesome. Yeah.
And we can actually plug it into the tax return both ways and kind of see which one is more beneficial.
Where they get the biggest bang for their buck.
Exactly. Another reason why it's really good to have an accountant, because we do these things for you. Because really our goal is to...
And if your accountant doesn't, you should probably find another one.
You should probably find another one. Okay. But that's the nice thing with an IRA is that you can wait until the tax deadline to put the money in.
Okay.
Okay. Where some of the other ones, you have to put it in beforehand. And we'll talk about that. Okay. So let's talk about the actual retirement plans that are considered business retirement plans. Okay. And yes, the Savers credit, the maximum credit is $2,000.
Okay.
Okay. All right. So I think probably the most popular plan for small businesses is a simple plan. And the reason I think that's the most popular is because it is simple. It's actually...
it actually lives up to its name.
Yeah.
Okay.
Basically what it is it is another type of IRA that is only for small businesses. And what it allows you to do is it allows you to put away for 2017 $12,500 of income into your retirement plan as long as you had profit of $12,500 or more.
So you can't create a loss with is what you're saying.
Exactly.
Okay.
You can't create a loss with any of these retirement plans. You have to have profit. And if you're over 50, you can put in another $3,000, which means the limit for you is $15,500. Now, the thing with a simple plan is that you have to match from your profits, okay? So typically with a simple plan, the match is 3%. Okay. For a simple plan, if you have employees who work for you, okay, you may have to put money in for them if they qualify to be included in the plan.
Okay.
Okay. But if they don't put money in, you don't match it. Okay. And it's only 3% of their pay. Okay.
So it'd be kind of like a 401k for a bigger employer.
Mm-hmm. Yeah, exactly. So, if you've ever worked for an employer where you had a 401k and they would match, a percentage of your income as long as you put in that much, Simple works the same way.
And you have to understand that, I guess, if you go into that and you end up with employees that you would have to pay it. Are there rules for qualification? I'm assuming you can't just say that you don't qualify and hire someone.
Yeah, so you have to have rules for the plan. Usually it's, they have to work 2,000 hours, before they have to be full-time. You can kind of adjust the rules if you want to make them. You can make them less restrictive, but you can't make them more restrictive. And the government has all of these guidelines for.
So you can say 1,000 hours, but you can't say 50,000.
Mm-hmm. Okay. Exactly. I've had some employers that, like you can't go into the plan until you've been there for a year. And, I've had some employers where you qualify after 30 days.
Yeah.
Okay. The nice thing too with a simple plan, and this is great, we've kind of talked about this strategy before where, if you are putting your kids on the payroll, simple plans have a lower, you can go onto those plans once you turn 18. Where with a 401k plan, which is what most people are familiar with, you can't go onto the plan until you're 21.
Okay.
Okay.
So just give me a second. I'm updating our file to say employees can work, as long as they work. I guess I have to take it down from 9,000 hours a year before they qualify. Okay.
Because there's only 8,760 hours in a year.
Yeah.
Okay. So the nice thing with simple plans is that as long as you have profit, you can put money in. Mm-hmm. And you can put in up to 100% of your profit up to, the 15,005 plus 3% match. So that's really awesome. Okay. I really like that.
It's nice and simple is what you're saying.
It's nice and simple. There's only the traditional option, right? So you can't have a Roth simple plan. I know there are a lot of people who are fighting for that, who want a Roth option for the simple plan, but we haven't gotten it yet. So
good luck.
Yeah, good luck, especially with all the tax reform. But it's interesting though, because the reason that they created Roths in the first place is because the Treasury wanted more money now. Mm-hmm. Right. So they didn't want people taking all these tax deductions for their retirement contributions and then hope they get the money at the back end. And that's why Roths were created. Mm-hmm. Was so that people would pay the money now.
Yes, but then they realized that they lose a lot of money, so then they limited what people could do with it.
Mm-hmm. Yeah. Right, exactly. So the next type of plan that a lot of small businesses use is a SEP. Okay, and a SEP is does
that stand for something?
It stands for a self-employed pension.
Okay.
SEP. Okay. This is also a form of an IRA. Okay. You can put a tremendous amount of money into a SEP. The contribution limit for 2017 is $54,000.
Since it's an IRA, that would affect what your adjusted gross income would be then? It's not from profit, it's from...
This is deductible. Okay.
Well, it depends. Can you do a Roth version?
You cannot do a Roth version. Okay, you can only do a traditional version. These are for people that are making a lot of money. Because the way a SEP works, and it drives me crazy because investment advisors are putting people into SEPs that should not be in SEPs.
Because they're not making enough money to get the advantage of it?
Right, because in order to maximize a SEP, you can only put in 25% of your profit. So if your profit is $20,000, you are capped at putting in $5,000.
Okay.
Okay. Whereas with a simple I can put in up to 100% of my profit, which means if I'm over the age of 50, I could put in, let's see, if I'm over the age of 50, I could put in 15.5 plus another 3% of the 20,000.
And now, as long as it's profit. So if your profit starts to exceed that, can you just change it?
You can't change it, but you can stop one plan and you can start another one. Now, some of these plans you cannot start like mid-year. Okay, usually with the IRAs, you have much more flexibility in starting them later. Then the other thing with a SEP is that you still have until the due date of your tax return to make the contribution, because you can't really make the full contribution until we know what your profit is for the year.
And because, like you're saying, it's like an IRA, a traditional IRA.
Okay. Yeah, exactly. So SEPs, you can put away a lot of money, but essentially in order to be able to put away the $54,000, you need to have $216,000 in profit. You know, whereas, you know, let's say that, you know, your spouse works full time and has a really good job, and you have a side business because you want to put money away for retirement. And let's say that maybe you make, you know, $15,000 or $20,000 a year. You don't really need that money to live off of. You just want to save for your retirement. Well, with a SEP, you can only put away 25% of that.
Yeah.
But with a simple, you could put away most of it.
Okay.
Okay.
So especially if the purpose is to help save money for your retirement is what the business is for, you're probably less likely to switch over until you, like you said, you're making a lot of money.
Yeah. So, I mean, that's the thing. It's like if you're over the age of 50, you can't put more money into a SEP until you make $62,000 in profit. That's the point at which you could put more money into a SEP than into a simple.
Now, if
you're over the age of 50.
If your spouse does not work for your company, but they work for someone else, can you put them, like, can you put money away for them into like their IRA or their, or create a SEP for them? Or
you're limited to one major retirement plan. Well, you can only put away the contribution limit.
Okay.
So if you have access to a 401k or a simple plan, you're limited to maxing out that plan.
Okay, so that's the total amount. You could split it up if you want to. But
and even if you like change employers mid-year, you can still only put in the maximum contribution. So let's say that you work for one company for half the year, put money into your 401k over there, then you switch employers and put money into the 401k at that job. You're still limited to the annual contribution limit for 401ks.
Okay, gotcha.
Okay. So, and I've seen clients run into problems with that because they're like, woo, it's another plan. I want to max this one out too. And then they end up getting, that doesn't work. So, you know, like a lot of people, they see that $54,000 number and they're like, this is awesome. I want that one. Okay. The problem is, well, let's talk about 401ks first, and then we'll kind of talk about the problem with both SEPs and 401ks. So there's also there are two different versions of 401ks that are available to small business owners. There's just a regular 401k, which is what you kind of think of when you think of big businesses. The problem with 401ks is they have more reporting requirements. If you have employees, you've got to start looking at if your employees are contributing. If they're not contributing enough, you may not be able to contribute the max.
So those rules, that's one of the questions I asked you, because I knew when I worked at UPS, managers were limited on what they could put in based off of the average of what the employees put in.
Yeah, and you can run into those issues with 401ks with a small business. Now, if you don't have employees, you can have something called a solo 401k, which kind of works like a SEP. It has the same contribution limit for the $54,000. However, it allows you to put in the first $18,000 if you're under 50, or the first $24,000 if you're over 50. So basically, the limit is $18,000, and then there's a catch-up amount if you're over 50 of another $6,000. And you can put in 100% of your profit.
Up to that point?
Up to that point.
Oh.
And then the rest of it is considered profit sharing at the 25% of profit.
Okay.
Okay, so that's kind of cool because then, you know, if you know you're not going to have any employees, and for the purposes of a solo 401k plan, your spouse does not count. So like you can put your spouse on the payroll and you could still have this plan.
So
if you hired any other employees, you can't. Okay. So what happens with this plan is, you know, the match from the company profit is up to 25% of your profit. Okay. The same thing with a SEP. You don't have to put in 25%, but 25% is what gets you to the max.
Okay.
Okay. Here's the problem with these two plans. Okay. So first off, if you have employees, the solo 401k no longer works. The only person you can employ is your spouse. You can have a regular 401k, but that's going to have a much smaller match. For a SEP, you can have an employee or you can have employees with a SEP. However, whatever percentage you put in for you have to put in for them. So let's say that, you know, you decide that you're going to put in 25% of your profit. If you pay an employee $40,000, you have to put 25% of their pay into their plan.
Oh, so it's not 25% of your profit, but 25% of their pay would have to go.
Yeah.
Okay.
Because you figure, like, so when you're a small business owner, you know, your profit is your pay, right? So, and the other thing too is like, okay, so if you put in $10,000 for them, that decreases your profit, which is less you can put into yours. So it's kind of a funky, like you have to do all the employee calculations first, subtract that from the profit, and then whatever's left over is 25% of your profit. But so, you know, small business owners, this used to be like, this was a really big thing like in the 80s as people were switching from pension plans. They were getting SEPs, you know, but if you have, you know, let's say that you have $200,000 in payroll, you're talking about $50,000 in SEP contributions for you to be able to put in your $54,000. And you can only put in $54,000 if you have enough profit left over to be able to do that. So the SEP is kind of, you know, if you know that you're going to be a solopreneur, you're never going to hire employees, and your income, you know, is over, you know, that, you know, let's say $60,000 mark, and it's always there, and you really want to put away a huge chunk of money, then it may be the way to go.
Okay.
Okay. But if you ever think you're going to hire employees, because basically if you hire an employee, you've got to terminate that plan
Before they start.
Okay. Because otherwise then it kind of, you know, if they get caught up in that plan and you've got to make that contribution, and you can elect to make no contribution, but then the problem is
You lose your contribution.
you can't put anything in, and you can't have more than one retirement plan at a time in a business. So if you don't shut that plan down and start another one, you're going to miss out on a whole year of contributions. So, you know, this is one of those things that there's a lot of options. It's incredibly complicated.
And this, remember, is just from the tax business side. This doesn't...
we haven't even invested the money yet, right? But I mean, the nice thing with, you know, most of these plans, you know, a SEP, a simple, a traditional IRA, a Roth IRA, these are very easy to set up. You can set them up pretty much with any online brokerage company. You know, most banks will do them for you. Just don't go to a bank. This is the only investment advice I'm going to give you. Don't go to a bank that's going to put your retirement plan in a CD, because you need to invest that money so it grows.
Yeah.
Okay. That's the only piece of investment advice I'm going to give you. And I'm not an investment advisor, and don't take my advice because it's, you know,
It's purely for entertainment purposes.
it's entertainment purposes only. There we go. There's my disclaimer. Our lawyers are very happy now. You know, but the whole point of putting money aside is so that the money grows with you.
Yeah.
And interest rates right now are 1%. So...
And remember, too, how tricky this is, right? And once again, that's why when you listen to shows, even with professionals, they'll say, make sure that you go talk to a professional about your specific circumstances, because you might have heard enough where you think, okay, I think that's the one I need, but there's some other specific, because of maybe something very specific about you, we can't cover it all here. So really, this is going to be thousands of dollars of your small business going into it.
Right.
And even more than that on the backside. So spend $100 to $300 to talk to an accountant, spend $100 to $300 to talk to an investment person. A lot of them will do it for free because they'll get their money back over time.
Right.
But maybe even a lawyer you need to talk to. It's worth a few $100 up front on something that's going to be hopefully bigger than your house when you're done.
Yeah. I mean, I know like our retirement plans are approaching the value of our house.
Yeah.
And it's one of those things that the earlier you start, the better. But it's better to start today than to start next year.
Yeah. This should not be a New Year's resolution.
Yeah. And, with most of these plans, you can start them today. You don't have to wait. The simple plan, if you're making profit, start doing an automatic withdrawal out of your business account every month. You can do this with a traditional IRA. Most people it's really hard for me to get $5,500 together, in March or April for me to do this, especially if you've got to make estimated tax payments and other things. So, that's, if you look at it to max it out, it's approximately, it's a little over $100 a week.
Yeah.
$400 a month, if you put that away and then max it out in March or April, it'll cost you a couple $100 to do that.
Yeah.
But I mean, and I know for some of you, you're going, my God, that's a lot of money. But I'm telling you, once, how much are you paying in payments right now? Right? Do you have a car payment? Do you have a student loan payment? Do you have credit card payments? I bet you if you wiped all that out, you could make that contribution easy. So, that's why we always say, clean up your debt as fast as you can and then start working on this. It's pretty awesome to be sitting where we're sitting, knowing that we've got as much in retirement as we do.
And knowing there will be more tomorrow.
Exactly. If you have any questions about this, if you're concerned about your particular business situation, we'll put a link into this episode. Sometimes we run some deals on some of our time. So, it'll be a link to a deal where you can get, half an hour with me at a reduced rate, just so that if this is something that you want to talk about, we can do that. And we'll make sure that we put a link to my calendar in the show notes. If you're in the HQ group and you want to ask about this, we'd be more than willing to help you with that. You're in the HQ group. That's another benefit of the HQ group is you get more complex questions asked than the other groups.
Or answered.
Yeah, answered. But this is something I think a lot of you aren't thinking about right now, unless you're in your 50s and you're going, holy crap, do I have anything saved? And even if this is kind of the philosophy that we've taken as we've saved for retirement. Jeff has a couple pensions that he's qualified for. We both have paid into Social Security as he laughs. We are planning for retirement as if none of that money is going to come through. As if, the pensions are going to go bankrupt. Social Security is going to go bankrupt, and there's a little asterisk on my Social Security statement that says this is how much we're going to pay you. And then there's a little star next to it. And it says, oh, yeah, by the way, the year you're supposed to retire, we're going to run out of money and we're only going to be able to pay 75% of the benefits.
And remember, too, people always talk about, they're worried about Congress working on fixing Social Security. The reason they're not super worried is because there is a fix built into Social Security. If the trust fund does not have enough money to pay out, they can automatically reduce the benefits being paid out. So it will function. You might not get the money you think you will on the backside. You really have to be able to take care of yourself in your retirement, especially the younger you are. The amount of debt we have, and I'm not smart enough to know if it's really going to go bankrupt or not. But I'm smart enough to be scared crapless because of the amount of debt we have. So you have to be able to take care of yourself here, because they'll tell you that they're taking care of you by the rules of Social Security now, and you might be able to get like a good pizza with that money a month.
And so that's the thing. So we've kind of said, all right, we're not going to rely on the pensions. We're not going to rely on Social Security. We're going to save our own way there. And so, we've taken advantage of 401k plans we've had. One of the reasons I stay at the university, people are like, why do you keep that job? First of all, I love teaching. Okay. Like, teaching is so much fun.
And that's why.
Yeah. I had a blast with my class the other night. But the other reason I do this is that if I put in 5% of my pay, the university matches 9%.
Yes. So that's a really good rate of return before the investments start.
Right. So you figure before I even start investing, I have made almost 200% on my money.
And one other suggestion, and once again, consider this entertainment advice. So talk to an investment professional before you do it. If you've come out of other jobs where you've had retirement plans, a lot of times the funds you can pick there are really bad. So if you have these other like 401ks that are sitting out there, try and get them rolled over into something that can be either invested for you through like an Edward Jones kind of company, which I've invested with in the past, or Capital One, where I can pick my own funds now by using their research tools to see what works really good over the long term for you.
Here's the one tax tip I'll give you, okay, about rolling over.
Which is really important.
If you are going to do a rollover, decide who you're going to invest your money with, whether it's like in Edward Jones or another local advisor or, an online brokerage, and have them request the transfer.
And have it go directly from your old to your new.
Because here's the problem. If you request a check, they are going to withhold taxes from that check. And if you do not put all of the money that you took out of the old plan,
including the money that they withheld,
for taxes, and put it into the new plan within 60 days, any money that does not go into the new plan within 60 days, you are going to be subject to a 10% penalty plus the ordinary income tax
that you currently are making.
Okay, so whatever rate you're at right now, on whatever money does not go into that new plan.
And remember, the rate will include all of the money from your retirement plan. So if you had $100,000 put away and you made $50,000, that will put you, before adjusted at 150.
So,
right?
let's say that you, you have $100,000 in an old 401k, and you request a check out of that. That's considered a distribution. They're going to withhold 25% of the $100,000.
So $25,000.
$25,000. Now, when you bring your check for $75,000 to the new brokerage company, in order to not get penalized, you have to come up with $25,000 from somewhere. Now, you can't tell the old brokerage company, "Oh no, I'm going to put that into another plan."
Right, get that back.
They are required by law to withhold the money. So, let's say that $25,000, you can't come up with it from anywhere. So you're going to get penalized 10%. So that's $2,500 plus whatever your tax rate is.
Okay, but it's just on the
only on the
part
money that you can't put in.
Okay.
Right. The other thing to be really careful about with retirement plans, and if you right now, say that you're working for a company and you've got a side business. If you borrow money from a 401k at your job, okay, this is such a bad idea. Don't do this. And if you've done it, go pay it back as quickly as you can. Don't wait for the payroll deductions. Pay it back as soon as you can. Because if you leave that job, or if you're terminated from that job and you have a loan outstanding with your 401k, if you do not pay that loan back, it will be considered a distribution subject to a 10% penalty and the tax on the balance.
No matter the reason, they might go out of business. If you stop working there before it's done, you're done.
It doesn't matter if you leave voluntarily, involuntarily, it does not matter. If you do not pay that back, you are going to get penalized. Okay, so you have to be super careful. That's why we tell people under no circumstances should you borrow from a 401k. It's just a bad idea. Okay, so so I know we kind of branched off, but there are a couple things that I think people don't really talk about. So if you stayed this long, you got a really good education about retirement plans and rollovers and all sorts of stuff.
And I hope my questions for not knowing helped you, because this is difficult stuff that you have to be cautious with. Remember, if you're serious about saving for your future, retirement is a great way to do that. But you need a plan going into it. And we're not even talking about the investing side of it, but you need a plan on how to do it. Spend some money up front if you need to get the proper advice to make sure you can get the most bang for your buck. Ultimately, that's the point of the retirement, because if you fall short and it was because of a bad decision you made, it's because of a bad decision you made.
Well, and the nice thing with retirement funds too, if, let's say something happens with your business, you're forced into bankruptcy, retirement plans are typically excluded from your assets in bankruptcy, which means they can't be taken to pay your debts. But the other thing is you want to make sure that you're balancing your retirement savings with your outside of retirement savings, because you don't want to go bankrupt because you don't have any money saved for rainy day.
And maybe we'll do an episode of that at some point too.
Yeah. But, I'm sure you're going to have questions about this. You can leave them in the notes of the episode. You can, ask in the Small Biz Life community. If you're in HQ, you can ask really detailed questions, or reach out and book some time with me, because I'd love to sit down and help you with this. So thank you so much. I know it was a complex episode. We'll put all the limits and everything in the show notes, and we'll see you next time.
This was Small Biz Life.